If you were born before 1961, the moment you turned 65, the law quietly pulled you out of a whole category of bills and taxes that you are, statistically speaking, still paying in full. And nobody whose job it is to collect that money will ever call to tell you to stop. That is the single most expensive misunderstanding that comes up again and again in conversations about retirement finances. Turning 65 does not just make you eligible for Medicare. It quietly reclassifies you in the eyes of the federal government, your state, your county, and a handful of other agencies, all of which are legally required to treat you differently from this point forward. There are bills that younger people still owe that you no longer do. There are taxes that shrink, freeze in place, or vanish entirely the moment you cross that line. But here is the catch that costs people real money year after year. Being legally entitled to an exemption and actually not paying are two completely different things. The law does not refund you automatically. Nobody at the county mails you a check. The agency that has been collecting from you for 40 years is not going to send a birthday card that says, "Congratulations, you can stop now." You have to know the exemption exists, and you have to file for it yourself. That single gap between qualifying and claiming is the reason most people who are fully entitled to these benefits never see a dime of them. And before you decide this video is not for you, let me clear up the biggest myth of all, because this is exactly how people talk themselves out of money that already has their name on it. Some people assume a list like this is only for lower-income retirees who are struggling financially. So if they own a paid-off home and live comfortably, they tune out assuming none of it applies. Other people assume the opposite, that this is only for the very wealthy with complicated estates. So, if they are living mostly on a Social Security check, they tune out too. Both groups are wrong, and both are leaving money on the table. Some items on this list help the lower-income retiree the most. Others are worth far more to the person sitting on a house that has doubled in value over the last few years. For every single one, the explanation covers exactly who benefits most, so that nobody can honestly say that one is not for me. If you are renting right now, do not click away either, because one item on this list quietly affects how fast your rent is allowed to climb, and it matters just as much to you as it does to the homeowner. Let us get into all 5 of them one at a time, in plain English, with the exact thing to ask for at each one. And stay through to the end, because the 5th item on this list is the highest value one of all, and it also happens to be one of the easiest to claim. If only one thing from this video gets acted on, for most people, that is probably going to be that one. The first item is the brand new bonus deduction for anyone 65 and older. Let us start with the newest one because it is so new that almost nobody has caught up to it yet. And that is exactly why it is being missed on so many tax returns right now. Starting with the 2025 tax year, under tax legislation signed into law in 2025, every American aged 65 or older qualifies for a new bonus deduction of $6,000. It is in effect for tax years 2025 through 2028. This is important to understand precisely because this is where people get it wrong. This is not a replacement for the standard deduction. It stacks on top of it. It is an extra $6,000 knocked straight off taxable income just for being 65. And if a married couple both qualify because both spouses are 65 or older, that is $6,000 each, $12,000 as a couple, layered on top of everything else they already receive. Here is the part that surprises people. This deduction is available whether the filer takes the standard deduction or itemizes. It does not matter which filing approach is used, which is what sets it apart from the older, long-standing additional standard deduction for seniors that has existed for years. That earlier deduction is only available to those who take the standard deduction route. This new $6,000 bonus works either way. It does begin to phase out at higher income levels. For a single filer, it starts shrinking once modified, adjusted gross income climbs past $75,000. For a married couple filing jointly, that threshold is $150,000. Above the higher cutoffs, it disappears entirely. But consider who that leaves in the picture. The vast middle, the retiree living on a normal, modest retirement income. For that person, this is real money taken straight off the amount the government is permitted to tax. What genuinely matters about this one is who is most likely to miss it. The people it helps the most are often the exact people least likely to catch it. The 65 and older filer with ordinary income who files a simple return on their own or hands it to a preparer moving quickly through a stack of them. That is precisely the person who will not notice whether this new deduction was actually applied, and who will quietly overpay without ever knowing. The action here is simple and takes about 2 minutes. When the return is finished, before signing it, look it over and confirm the enhanced deduction for seniors was actually taken. When using tax software, make sure the date of birth was entered correctly because that is what triggers the deduction. This is not a dispute with anyone. It is a line on a form that simply has to be there. The second item is the property tax bill. This is where the biggest dollars on the entire list are hiding, so pay close attention. There are actually 3 separate forms that can be stacked on top of each other here, and most homeowners do not have a single one of them filed correctly. The first is the homestead exemption. It takes a chunk of the home's assessed value off the books before the county ever calculates what is owed. In Florida, that chunk is $50,000. In Texas, it is $100,000 off the school tax portion of the bill. Every state handles it differently, but in nearly every state, it represents real money. Here is where people get caught. Most homeowners assume the homestead exemption is automatic, that it just kicks in the day the house is purchased. In most states, it is not. There is a 1-page form to file with the county, usually once ahead of a spring deadline. File it once, and in many states, it stays in place for as long as the property is owned. Miss it, and the full bill gets paid that year for no reason at all. The second form sits right on top of the first. It is the senior or age 65 exemption. Most states that offer a homestead exemption also offer an additional one that kicks in the year a homeowner turns 65. And this is the one the county will almost never mail notice about on its own. It is a completely separate application that has to be asked for by name. In Texas, every homeowner 65 and older gets an additional $10,000 off the school tax portion on top of the homestead exemption. In Florida, the senior exemption can add another $50,000 on top of the basic $50,000, effectively doubling the write-off. And here is the part where comfortable retirees wrongly tune out. They hear the word senior and assume there must be an income test they will fail. But in more than half the states that offer this, there is no income test at all. Texas, Florida, Georgia, Tennessee, Alabama, and others. Age 65 is the only qualification. The form gets filed, the exemption applies. The third one is the most valuable of all, which is the Senior Assessment Freeze. Here is what it does. When the freeze application is filed, the county locks in the home's taxable value at whatever it is the year of application. From that point forward, it does not matter how much the neighborhood appreciates or how high values climb on the surrounding streets. The tax bill is calculated on that frozen number. In Texas, once the over 65 tax ceiling is in place, the school district tax is frozen at the actual dollar amount paid that year. The home's value can double. The bill cannot rise. Who does all of this help the most? Everyone, honestly. The basic homestead exemption helps the lower-income homeowner the most in percentage terms. But the freeze is worth a small fortune to the person sitting on a paid-off home that has tripled in value in recent years, because those are exactly the homeowners staring down the biggest potential future increases. And for renters, as promised, the landlord pays that property tax bill and passes every dollar of any increase straight into the rent. When those bills are frozen or reduced across a community, rents stop climbing the way they otherwise would. The third item is the Medicare Part B premium. This is the one quietly pulled out of Social Security checks every single month before the money ever lands in the account, which is exactly why a lot of people forget they are even paying it. For 2026, the standard Medicare Part B premium is approximately $229 a month, and that amount comes out automatically month after month. But here is what almost nobody is told. There is a set of programs called Medicare Savings Programs. If income falls under the limit, the state pays that Part B premium outright. Not lowers it, pays it entirely. There are 3 tiers going by the initials QMB, SLMB, and QI. The most generous, QMB, does not just cover the premium. It also wipes out most of the deductibles and copays on top of it. What matters about this one and why it deserves extra attention is that the income limits are far higher than most people assume. A lot of people glance at the word assistance, decide they must make too much, and never check when they would actually qualify. On top of that, many states no longer count assets at all in the eligibility calculation. So savings, or a paid-off home, do not disqualify someone. Despite all of that, this remains one of the most underclaimed benefits in the entire system. Millions of people who currently qualify have never applied, purely because no one ever told them the program exists. The action here is one phone call. Calling the State Health Insurance Assistance Program, known as SHIP, which is a free service, will result in a screening for Medicare savings programs and help with the application. That one call can put close to $200 a month back into a Social Security check. Over a full year, that is a significant number. And while on that call, ask about one more thing that often travels right alongside it. It is called extra help, sometimes known as the low-income subsidy. This one targets the cost of prescription drugs under Medicare Part D. If someone qualifies, and many of the same people who qualify for a Medicare savings program also qualify for this, it can dramatically lower what gets paid for medications, the drug plan premium, and the deductible. In many cases, getting approved for a Medicare savings program automatically enrolls someone in extra help as well. That is 2 of the biggest healthcare cost breaks in the system, both unlocked by one phone call and one application. The 4th item is phone, internet, and energy assistance. This one is smaller in dollar terms, but it is still a bill that can legally stop being carried in full, so it belongs on this list. There is a federal program called Lifeline that takes about $9.25 a month off a phone or internet bill. Many states stack their own discount right on top of that, which can push the savings higher. Separately, if heating or cooling a home is a strain on the household budget, there is a program called LIHIP, the Low-Income Home Energy Assistance Program, which helps pay that utility bill directly. This is not the most dramatic item on the list. $9 a month is not going to change anyone's life on its own. But here is how to think about it. It is one more recurring bill that the system already decided people in this situation should not have to carry alone. And it sits there unclaimed year after year for the same reason as all the others. It only comes through if someone asks. When these programs are stacked together alongside the bigger ones, the small ones, and the large ones, that is when the monthly number really starts to move. The fifth item is the long-standing additional standard deduction for seniors, and this is the one to stay through to the end for. This is the item that quietly costs the most people the most money year after year, and it is also the single easiest one to fix. Earlier in this video, the brand new $6,000 bonus deduction was covered. On top of that, the tax code gives every filer aged 65 or older a second, entirely separate additional standard deduction, one that has been in the law for years. For the 2026 tax year, that is roughly $2,000 for single filers and approximately $1,650 per qualifying spouse for married couples. It stacks right on top of the regular standard deduction everyone gets, and it now stacks with the new bonus deduction on top of that. Put all three together: the regular standard deduction, the long-standing senior add-on, and the new $6,000 bonus, and a large number of people over 65 owe far less in federal income tax than they currently believe. A meaningful number of them owe nothing at all. But here is the quiet trap. Those same people keep over-withholding from their pension or Social Security out of sheer habit, or they hand their taxes to someone who never stops to adjust for their age. Year after year, they hand the government an interest-free loan and call it normal. This is the most common and the most fixable money mistake that comes up for people over 65 who review their tax situation carefully. What most people do not fully understand is that the tax code is not hiding this out of malice. It is simply that no part of the system is set up to walk over and tell someone. The easiest move is this: when the return is prepared this year, confirm that both the regular standard deduction and the age 65 additional deduction were applied. Then ask whether the withholding on pension or Social Security income should be adjusted going forward so that overpaying stops each month. It is not a battle with anyone. It is a box that simply has to be checked correctly. Now a few additional moves for homeowners who have real assets and want to go further. The first bonus move is the property tax deferral. In a number of states, once a homeowner reaches a certain age, they can choose to stop paying the property tax bill entirely, and the state simply settles up later when the home is eventually sold or passed on to heirs. Cash flow stays intact in the meantime. The second is the surviving spouse carryover. When one spouse passes away, senior exemptions and assessment freezes do not automatically transfer in many jurisdictions, and families lose them by accident. But if the right paperwork is filed, the surviving spouse can often keep the deceased spouse's exemption alive instead of watching the tax bill jump significantly in the most difficult possible year. The third is one that people often overlook until they add it up across multiple years. In a number of states, once a certain age is reached, vehicle registration or annual excise fees get reduced or waived entirely. It is a smaller dollar amount year by year, but it accumulates. Here is a way to bring all of this back to a real household situation. Picture a 72-year-old widow living in a paid-off home that has quietly doubled in value over the years, getting by mostly on Social Security and a small pension. When the full picture of her situation is examined, Three things might be found running simultaneously. She is paying the full Medicare Part B premium every month. She is paying the full unfrozen property tax bill on a home that has appreciated for years. And she is paying more in federal taxes than she actually owes, because the senior deductions were never applied, and the withholding was never adjusted. All three of those are things she has the legal right to stop paying or to dramatically reduce. Filing three forms, a Medicare Savings Program application, the senior exemption and assessment freeze with the county, and a corrected tax return, would change the monthly financial picture entirely without her moving, selling anything, or changing any other aspect of her life. The only thing that changes is how much of her own money stays in her account every month. She would not be gaming the system. She would be claiming what she already earned over a lifetime of doing everything right. That is the entire point. Here is exactly what to do this week, and none of it requires spending $1. First, call the county assessor's office and ask by name whether the homestead exemption, the senior exemption, and the assessment freeze are on file for the property. If any of them are missing, ask which form needs to be filed and what the deadline is. Second, call the local SHIP office and ask for a screening for Medicare savings programs. That same call often surfaces the extra help subsidy for prescription drug costs as well. Find SHIP contact information by state at medicare.gov. Third, the next time a tax return is prepared, confirm that both the regular standard deduction and the age 65 additional deduction were applied. And ask whether withholding should be adjusted so that overpaying month after month stops. And if the cost of hiring a tax preparer has been part of why this has been put off, listen closely, because it does not have to cost anything. There are 2 free programs staffed by IRS-certified volunteers specifically for this purpose. One is called Tax Counseling for the Elderly. The other is the AARP Tax Aid Program. Both will sit down and file the return at no charge, and both are specifically trained to apply the senior deductions that often get missed in commercial settings. A few phone calls and a couple of forms. That is the only thing standing between most people and money that has already been theirs this whole time. This video is for educational purposes only. The information shared here reflects general knowledge gathered from publicly available sources including YouTube, Google, and news reporting, and represents personal opinion only. It is not legal, financial, or tax advice. Tax laws, benefit program eligibility rules, and exemption thresholds vary by state, county, income level, and individual circumstances. Always confirm the specific rules that apply to your situation with your county assessor's office, your state health insurance assistance program, a qualified tax professional, or another licensed advisor before taking any action.